when you're done setting the goals, you've got your data mapped, and you come back and look at the leading indicators. And now, at this point, you probably have a little bit of a different picture. Here is just more. I'll go into this a little deeper. Again, these are average monthly numbers. So we had a 10% increase in revenue that we'd like to see. Had we had a 10% increase over the previous quarter, we'd have about 115,000 average month. It was 103, so we're off by actually 320% if you do the math, and that'll show you how we calculate the math. And because we're more than 10% off the goal, then we've got a red color for this particular indicator. So since we didn't meet our goal, again, we're using the percent of revenue goal here, and had we met that goal, it would be 82,000. We're actually at 94, which is less than 20% off goal. So you get the orange-yellow color. Gross margin, we had a 40% of revenue goal. We actually had 62%, and so we've met the goal for this one. And remember, you can change the line of business at any time here. And it will refresh. And now you're seeing the picture based on just the information for the service line of business. Now let's go back and look at, do a little bit deeper dive. We want to go look at the revenue, the last 2 years of revenue for this company. 2-year view ending at the date shown here. This company has actually had a 19.6% growth over the past 2 years. This is past 12 months compared to prior 12 months. This is just an indication of the range of over and under this rate line. The rate line here is the trend line for revenue. So in general, our revenue is trending up. We're making more money month by month. And then if I come down here and put in the goal, you'll notice that it starts right on January of 2011. We have to have a place to start to calculate the goal amount. So we start right here on the rate line, not on an actual number, but because this is the trend, it's a reasonable place to start. That's why this date is important. So starting at this point, our goal for 12 months will be based on that plus a 10% increase from there. And you can actually see the individual numbers down here as you go over each point on the lines. I can also put in the expense numbers here. And in this case, I'm doing a reasonably good job, or my friend Max's bookkeeper is doing a reasonably good job of keeping expenses and profit in line on a monthly basis. If you find that these spikes are not in sync, maybe you've got a big spike in revenue here followed by a spike in expenses. If you're a cash basis taxpayer, the timing of recording financial information is typically not that important. But if you take some care and try to do that, then of course your analysis of profit and loss for any one month will be much cleaner. And then if you look at this and you see a spike, knowing that you've already set in motion the processes for recording those things properly, if you see a spike here, then you say, aha, something happened that we missed something. The biggest spikes that I see when I help people set up their companies is the accountants will come in the month of December and throw 12 months worth of depreciation in December, and that doesn't do you any good when you're trying to understand your profitability. A couple things you can do about that. You can go back to QuickBooks and spread those expenses backwards. And so the next time you load data, we pull in the most recent 36 months. We'll get the refresh data will get all of those prior period adjustments and pull them into Corelytics and make that happen. There's also, under configuration over here, there's an adjustments facility where you can actually make adjustments to the numbers in Corelytics if you don't want to make any changes to QuickBooks. Making the change in QuickBooks, of course, is cleaner and easier. And then if you find that situation, have a talk with your accountant to figure out how you can do a monthly entry to anticipate things like those month-end or year-end expenses that the accountant will throw at you. So also again on all these displays, you're going to see the benchmarks, the SL index. Remember that your goal is a forward-looking number, and the benchmark is based on history. And so you can see the benchmark actually starts at this point and starts calculating. It's a historical view, so if you're comparing yourself to this number, remember it's what people have done, and this is what you hope to do. And as you look at this, I say, you know, my 10% is not optimistic enough. I can actually click on the Update Goals link here, go right back to that goals page and make the change. And then we have a forecast view here. This is the most recent 12 months to the left, and then just a sort of a trend into the future. And what we've done here is taken that trend line and just we're displaying that into the future, which basically says if you keep doing what you've done for the last 2 years, then this is probably where it's going to go. If momentum is going to carry you someplace, that's where you're going to be. And then and so that represents about an 18.3% growth year over year. And then we look at the last 6 months and take another trend line for that. And in this case, that line is trending down. It looks like it's going to be negative growth. And what we're saying here is just think about what's happened in the last 6 months. Did you get a new customer? Did you lose a customer? Did you have a big sale in a previous month, a previous quarter, and you didn't have as big a, say, a product sale here? Then that secondary line may be below the rate line. It may be above. So this is just a way to visualize and look and see where you're going, and then think about most recent history, and is there a trend there that you need to recognize early so that you can make some adjustments. And then we can put in the expense rate line. Again, the same kind of trend line for expenses. And in this case, what we're showing is that we've got a healthy difference between revenue and expense. That's always good. And they look like they're climbing at about the same rate. Maybe they're converging a little. Maybe they're growing apart. And there's an expense profile, or expense page we can look at here as well. And so this can be instructive. There's times when I've seen these two lines going in different directions. The revenue trending down and expenses trending up. And I had someone ask me a few months back, why do those two lines cross out there? What does that mean? I said, that means you're not going to have enough money to pay your bills. Oh, what do I do about that? Well, obviously, spend less, bring in more business. But the point is, this gives you a chance to see the trends and pay attention to them when you have enough time to react by making small changes, instead of waking up one morning and realizing that all of a sudden you've got to make a huge overhaul change to your entire company. This display is available for the exact same display for expense, profit, and gross margin, and viewed by month and or quarter, and by line of business. You get the same information here, and in this case, this either means that I'm not charging enough for my services, or that I've got a problem with the allocation of expenses in my data map. And this is test data and not well constructed in some places to tell the right story. So, but then again, you might do this and say, wait a minute, is this really true? You go back and look at your expenses and realize you're losing money on a particular line of business. Then you thought everything was just fine. And maybe time to change your product mix, look at your pricing, do whatever it takes.